Welcome to the investment overview for the Spartan Income Fund. And tonight we're going to talk about the Spartan Storage Income Fund that provides investors with cash flow, upside, and depreciation. And before we get started, I'd like to get our disclaimers out of the way. And again, we're talking tonight about the Spartan Storage Income Fund. And the Income Fund is part of a three set of funds, the Debt, Income, and Growth Fund, that we are going to launch in 2023. But tonight is all about the Income Fund. So our disclaimers are that we're not offering any legal, tax, or investment advice. Do your own due diligence on the investment. This is just a general overview. And consult your tax and legal team, meaning that we're not giving tax and legal investment advice. We're not providing any strategies for your tax or investment portfolio. We're just giving a general overview of what we intend to do for the Income Fund this year. And again, all offering docs are going to be in the investment dashboard. So log in, you can find our PPM, subscription agreement, things like that. All those are going to be uploaded in the coming weeks. We just wanted to give you a preview of what we plan to do this year for the Spartan Income Fund. So the Spartan Income Fund, as mentioned earlier, targets cash flow, upside potential, and depreciation. So if you're looking for those three things, you're in the right spot. The target returns for the Income Fund are about 14 to 20% annual return, meaning that over a 5-year hold period, you can look back and expect to make 14% to 20% per year on your money. Now, that makes up two things. That's upside, like I mentioned earlier, and cash flow. We're targeting about 4 to 8% cash flow throughout the course of the hold period, starting in that lower 4%, mid-single digits in the first couple of years, and then increasing as we add our value to the properties. And that targets about a 1.7x or 2.0x multiplier, which means that you can expect to basically double your money in 5 years. For example, if you invest the minimum of $50,000, you would expect to get your $50,000 back plus about $50,000 on top of that, total of $100,000 over a 5-year hold. Now, we're going to talk about the cash flow projections tonight and how you can benefit from the monthly distributions that we do. We're targeting, as I mentioned earlier, 4 to 8% per annum cash flow that's distributed on a monthly basis. And cash flow is projected to start within 90 days of your funds going active, meaning that if you put your money in, it might take as long as 3 months for it to be put to work and then deployed into the purposes of buying a property or fixing up a property. And you could expect your investment to start paying distributions about 90 days after that point in time. And we do our distributions on a monthly basis. We send out our distributions on the first of every single month via ACH to our investors. So let's look over the 5-year hold period for cash flow. We can expect about 4 to 5% per annum cash flow in the first year, that increasing to a range of 4 to 6% in the second year, 6 to 8% in the third year, then it increases to that 7 to 8% window in years 4 and 5. So let's walk through an example. $100,000 invested, and you can expect that that's going to earn about $4,000 to $5,000 of cash flow in year 1, 4 to 6 in year 2, 6 to 8 in year 3, 7 to 8 in year 4, and year 5. And so that means that you're going to have about $28,000 to $35,000 of projected cash flow over the 5-year hold period. And if you're doing quick math, that makes about $333 per month in distributions to about $666 in per month distributions for cash flow. So not too bad on the cash flow projections. We talked a little bit on our previous webinar, on our overview, about the 3 investor share classes in our 2 equity funds, the Growth and Income Fund this year. The way that the Income Fund is structured is we have 3 investor share classes, Class A, B, and C. Now these share classes are based on the investment minimums of 50 to just shy of $1 million for Class A, $1 million to $3 million for Class B, and $3 million above for Class C. Alternatively, if you invest within the first 45 days of the fund opening, which is going to happen on March 1st of 2023, you can also get bumped up. So if you invest $50K in Class A, you actually get bumped up to get the benefit of a Class B. And we're going to go over what those benefits are right now. Now, likewise, if you invest the minimum for a Class B in the first 45 days, you'll get the benefit of a Class C share. And there is quite a significant difference in the different classes of shares. First of all, in a Class A investors are going to get a 7% preferred return. And if you're not sure what a preferred return is, you can visit our website and look it up. But basically, it means that you're going to get 100% of the cash flow to the investors first. So the investors are going to benefit from 100% of their investment amount, 7% preferred return, or 7% per annum of cash flow before there's any splits with the sponsor. So you get that benefit of a 7% preferred return. That just gives you a better incentive alignment. However, if you're in the Class B or Class C share, you're going to actually get an 8% preferred return. So you get a full percentage point better than a Class A. The next step in the waterfall, or how money gets chopped up or distributed into the investment, is a 70-30 split until a certain per annum annualized return is achieved. And for Class A members, that's 14%. For Class B, it's 15%. And Class C, it's 16%. So you can see the share classes are offering better splits for early investors and larger investment amounts. So let's talk about the back-end split. Once you've hit that 14, 15, or 16% hurdle, you can expect that there is going to be a split of whatever's left over. So in the Class A share, it'll be split with the sponsor or with Spartan Investment Group 50-50. And the Class B share, it gets better and goes to 55-45. And the Class C share is the most favorable at 60-40 split. And these are the most favorable splits that we've put out there to our investors. And we think that you'll really benefit from investing early and investing a larger check size. Now, what does that really mean? How do we boil down what that means in returns? Well, let's just talk Class A first. If you're a Class A investor, and for all these examples, by the way, I'm going to use $100,000. So that way it's easy to follow along and compare the two different ones. Obviously, for Class B, the minimums are $1 million, but I'm going to show what it would be on a $100,000 basis. So Class A investors, they put in $100,000. They can reasonably expect within the range that I provided earlier, projected returns, a 92% total return over a 5-year period. This means that they're going to get their $100,000 back and $92,000 on top. That's a 92% total return to the investor. However, Class B investors, if they invested that same $100,000 in the same scenario, they would actually get a $197,500 return, which means they're getting about a 5.5% total return difference, which is better than the Class A share. So that's the difference. So if you're thinking about investing early, that's advantageous. If you're thinking about investing more, that would also be more advantageous to bump you up to Class C, which at a $100,000 comparable investment would actually return you $201,000, and that is a 3.5% benefit over Class B and a 9% benefit over Class A. So you can see you're really starting to spread the margin there over what the other share classes get. So it benefits you to invest early. And like I said, first 45 days gives you those two benefits of getting bumped up. So now we're going to talk about depreciation. Everybody loves depreciation. We all know that we put all of our properties through a cost segregation study, which basically breaks in the useful life components into 5 and 15-year life, and we do accelerated depreciation, meaning that in the first year, we actually apply bonus depreciation, which I understand is now only 80% of what it was. But again, it's still a great benefit. And we're going to walk through what you could expect for depreciation. So on $100,000 invested, you can expect about 30% of that to become a tax loss for you. This is a good thing, in a good way, have depreciation. So that's about $30,000. So if you put in 100, you'd expect about $30,000 in depreciation. And so let's walk through a scenario where you get a $32,000 cash flow distribution before we sell anything. So here's a table that I put together for everybody, and this will be shared with the investors. And this assumes an investment of $100,000. It assumes cash flow over the 5-year period of $32,000 and that $30,000 depreciation hitting in year 1. So this is your starting depreciation here. And you can see if we just focus on year 1, I'll go through one example. If the cash flow is 4% like we targeted, that would give you you'd have a big tax depreciation blocker that you wouldn't have to pay any income tax on that, $30,000. And so that means that you would have $26,000 left over in depreciation that rolls into the next year and the next year and the next year and so on and so forth. meaning that all this cash flow that you're getting in years 1 through 4 and some of year 5 is actually not going to be taxable until the asset sells, and then there might be capital gains, etc. So again, I'm not a CPA, and so like I disclosed in the beginning, make sure you check this with your financial advisor or whoever's helping you on your team. But this is a really great benefit, and the benefit will be passed along to the income investors. So let's talk about our secret sauce, what we do. What is our value add strategy? You might be a multifamily investor, you may have invested in Spartan before, but what do we do to actually produce returns and create value in storage or in this metal box with 4 walls and a concrete pad? Well, typically we buy from mom and pops, and mom and pops are going to be your typical rundown facilities. They've got failing CMU, concrete masonry block, units are left abandoned, auction processes are not upheld, revenue management is abysmal, they don't have a call center, they don't have a website, they're not listed on Google, they're not marketing for new customers, they're just 100% full usually and not really charging what the market rates are. And sometimes they look like this. That top right picture there is a tree growing out of the metal building. So we come in and we deploy our value add strategy. Sometimes we see things like no signage on the main driveway. Sometimes we see signage that doesn't connect to a working phone number or is missing letters and numbers. Sometimes we see cars sinking into the mud on the front of the property, and it looks really run down, and it doesn't look like a safe place to store your belongings. And overall, we just see a lot of deficiencies in the look and feel of the property that makes a customer want to book at a facility. So we come in and we deploy our value add strategy. So just a small example, one of our facilities in Colorado, this is what it looked like when we bought it, rundown sign, things like that, no working website, and we come in and just professionalize it through our free up storage brand standard. So that's kind of a good example of what we do. The other thing that we do is we really enhance the signage, curb appeal, landscaping, drive aisles, concrete, paint, everything that goes into making a place that you want to go book there and really trust the facility. So you can see just a couple of examples of what we do. Painting the pole sign, putting in a new sign, putting in lighting, putting in landscaping. These are things that make our properties shine and get a lot of walk-in traffic. So a couple more examples here. And the other thing that we do is we renovate the offices. So over the years, we've seen it all. We've seen red rooms. We've seen an office that had 14 cats in it. We've had offices where you barely can even move around in there. We've had offices with 5 computers and 5 printers and just really inefficiently used. So you can't sell merchandise. It doesn't feel retail. It doesn't feel like a business. It feels like somebody living out of it. And here are just a handful of pictures of properties. Some of those are from the Southeast portfolio. Some of those are from the DFW portfolio. One property is our Colorado location, one of our Colorado locations. But what we do is we go in there and we renovate the offices, and we have a brand book that dictates what our offices should look and feel like. And these are just some of the examples, branded rugs and retail merchandise and things that drive confidence not only to book, but also drive a little bit of ancillary revenue where people buy the belongings or buy boxes and tape and supplies and things like that in the office. The other thing we do is we provide safe and secure facilities. We want the customer to know that when they book there, their belongings are going to be protected and safe. So we make sure that all the perimeter fencing is in place. We put security cameras in all of our properties. We have monitoring TV screens when you walk in, that it's right there so people can see that their stuff is being monitored, etc. We replace locking mechanisms on doors, as you can see in the bottom left, and we just want to make sure that we have a quality, clean, secure looking facility. That top left picture there is actually the Havelock, North Carolina. If you notice, we've already come in, we've repainted the entire property, we put our brand standards in place, we've made sure it's safe and secure, and replaced a lot of the security systems on it. And we do all this under the direction of the president of Spartan Construction Management, Aaron Saunders. And he leads a team of contractors across the country that is a Spartan in-house team, and they do all the initial improvements, all the signage, all the things that make our properties top REIT quality standards. And so we do an in-house construction from the ground up all the way to hanging a sign at the property. We oversee it from soup to nuts. The other thing that we do is we have strong community involvement. So these are just some of the pictures, participating in a holiday parade, participating in a mayor event in Tyler, Texas. This is a ribbon cutting in Sandy, Oregon. This is another ribbon cutting in Black Diamond, Washington. This is some of our team members doing trail enhancements in Colorado, and the local fire truck at one of our properties. We bring in the mayor, we bring in city council, we bring in the planning department. We want to provide the sense of community at all of our properties, and this builds trust and it builds awareness. We get featured on people's social media sites like the Chamber of Commerce, and we just have this nice community enhancement involvement with the property so that we can get a good reputation and people want to book with us. The other thing that we do is we enhance our ancillary revenue streams. So you can see here, some of our properties actually have U-Haul, so we will go out and we will contract with U-Haul and we do a revenue share with U-Haul. So we get some revenue from renting the trucks, but really it adds a sense of convenience. That's the most important thing. You're not going to become rich overnight renting U-Hauls to people, but what you will do is you'll attract more customers to your facility because, hey, I can pick up that U-Haul truck and I can rent a unit at the same time. The top left there is one of our own vans that we offer 1 month or one van utilization if you move in. So on the month that you move in, you can use our van for free and move yourself in. Likewise, we can rent it out for a profit. So just some things that we do that are pretty standard in the REIT level performance of a property management company. The other thing we do is we do merchandise sales and branding. When you walk in, we want to be a place of convenience. We want to enable you so you can buy a box, you can buy some packing supplies, you can have kind of a one-stop solution. Again, no one's making a ton of money on the retail sales, but it really helps with just the confidence building and the convenience that our retail store locations provide. Storage Defender. This is becoming more important. We put in Storage Defender in some of our units and then rent our units for more of a premium, or we get more demand for those units because there's a surveillance system in each of the units which allows the customer to know when their door opens and closes. So if they get broken into, they can see that their unit was open and it was maybe some weird hour of the night or something like that. So we have Storage Defender as an amenity at some of our locations. And lastly, I'm going to really go long on this, but we do tenant insurance. Tenant insurance is a huge benefit for our investors and for Spartan. And this is how it works. When we buy a property, we require tenant insurance. Some mom and pops don't have requirements for insurance, or they don't offer a revenue share program with their customers. So how this works is Spartan offers, or Free Up Storage offers, really 2 monthly products, a $13 a month product and a $22 a month product. And the per unit plan gives us a 70-30 split in revenue share, meaning that from that $13, we get 70% of that, you with the investors are shared with this tenant insurance premium, and then Bader takes the other 30%. So we have a nice favorable 70-30 split. And what this does is it allows us to really add a lot of income right out of the gates. So average facility size is about 550 units. And about 60% of our customers adopt the Free Up plan. They're required to have insurance. They don't have to have ours, but most take it because we make it very convenient. So let's just say 550 units. We're going to just use an example here. 330 units get booked with our premium. That's $13 a month. That's about $36,000 a year of extra NOI that comes to us at a very, very low or nominal cost. And so that's about $1 million of value to a property of that size that we can add on the day we take over. So that's just one of the many things that we do. The other thing that we look for is deeply discounted rents. So we want the subject facility to have great occupancy and below market rents. And what we mean by that is when we do a market study, we'll go mystery shop every single property in that market. We do boots on the ground, knocking on the door, pretending to be a customer, whatever it is. We get all that data and aggregate it, and we compare like-kind facilities to the one that we're buying. So if it's a Class C facility, kind of run down, we will compare that to Class C facilities. If it's Class B, if it's glass, 3-story Class A facility, then we can compare and contrast the rates. And then we average them out and we see what the differences are in our subject site rents and what the market is charging. And so what we can see in this example, you can see that our subject facility is charging $135 for a 10 by 20 and the market's charging $155, suggesting a $20 below market rent for our current customers. That provides a strategy for us to raise rents to market. And every single facility we buy in the fund, we post in the dashboard a complete feasibility study. So we'll share with you all the market rent comp data for every property that we buy. We share things like income and job growth and major attractions to the area. These market studies are done on a property by property basis. Now, what happens? So let's just say this guy here is getting charged $30 a month. And we come in and we buy this property and we do our market study. We decide that we see that there's a $60 per month market rate for this type of facility. Maybe it's a 10 by 10 or a 5 by 10, whatever it might be. And we decide when we take over, we have 30-day leases, meaning that when we buy the property, we can raise rents within the first 30 to 60 days in a property. So we can come in, we can adjust the rents right away. So we'll see that the market is $60 a month. So we'll just say, hey, we're going to slowly boil the frog here and just raise the rents a little bit and raise it up to $50. And that customer is faced with a decision. Should I call the other competitors, which are A, usually all full, or B, charging more, or C, do I really need the storage unit? So let's just say they decide, you know what, I'm not going to pay this. I'm going to move out. The big but there is we get a move in now. We go out, we start marketing our service, we're better SEO, website, call center, all that. We get a customer that moves in at 60. So now we've taken one unit, one economic value of a unit and made it 2. We've actually doubled our economic occupancy in this instance by raising that rent, getting that lower paying customer out, getting a higher paying customer in. And the reality is most of them stick around and deal with the rent increases because they really need the storage unit and the market charges more and it's full. So let's talk about our in-house property management team. We don't outsource really anything as far as property management goes and construction. So our value-add strategies, we actually use our own in-house property management team, Spartan employees, under the banner Free Up Storage. And so one of the things that we offer is 24/7 online bookings. It's incredible how many operators don't offer this when we take over. We fully automate the properties. We do staff training, revenue management, and we deploy a call center. So these are kind of the high-level things that we do to really drive value. And one thing that's great about Spartan, because we do it in-house, we actually share the tenant insurance with you. So a lot of people ask, you guys are charging 6% per property management. That's true. But what they don't realize is that third-party property management would still charge you 6%, and they wouldn't share the tenant insurance revenue with you. So if you think about the massive benefit that takes away, it's really, we're a very affordable property management company, and we're doing it internally and sharing that benefit with our investors, unlike a third-party property management such as like Extra Space that doesn't share tenant insurance revenue with you. So where do we invest? What's our typical market? So we like to say we invest in secondary and tertiary markets. And you could ask 5 different real estate investors what that means and you get 5 different answers. So I'm going to really narrow in on what this fund is going to buy and what a secondary and tertiary market means to Spartan. So all the red little pins here are real facilities that we own in and surrounding the Dallas-Fort Worth Metroplex. And you can see if you go into Google and you just kind of put in Dallas and you zoom out a little bit and you put in Free Up Storage, all those drop pins will show up. And you can see that we are not investing in facilities in downtown Dallas or downtown Fort Worth. What we're doing is we're investing in all of the communities surrounding the Dallas-Fort Worth Metroplex. And we have a cluster out in East Texas in Tyler and Longview. So we don't go into the urban core and compete with all the major REITs. What we do is we go out to the suburbs surrounding a major population and we invest where all the population is going. The trends, the growth patterns, all are going out to that area. So we want to capture those markets where we can be one of the top operators in those markets. So that's where we invest. Couple more examples of where we invest. We look for high visibility traffic. So we want to see a high traffic count, well located, good visibility from the main road. We like to cluster our properties together. So if you look at this map here, We have quite a bit of facilities in Georgia and Texas. That's where our biggest footprints are today. And you can see all the little red clusters with all the names of the properties. We like to cluster our properties and centrally locate so that we can get economies of scale with these properties. So we can have an area manager oversee multiple facilities. We can have a DM in the region. We can get efficient. And what we can do is we can really start to enhance our NOI because we have lower cost of payroll. And that ultimately gives us an advantage for better returns to investors. The other place that we like to invest, and you'll find this in the feasibility study, we like strong job growth, net positive migration, storage demand per capita exceeds supply. We like to see rent growth, income growth, and then lastly, like I was mentioning earlier, economies of scale with our other properties. And so these are just some of the ingredients that go into making a good market for the income fund. Exit strategy. Now, we're going to go through our exit strategy, and everybody's like, what's your exit strategy? Well, I always encourage real estate investors and any investors to have multiple exit strategies. You don't just want to have one exit strategy because that's probably going to change. You'll know in our growth fund, we're going to build and sell new properties, but we also have an option to build, hold, and operate that property because those markets come and go. Sometimes you can't just build a property and expect there to be a market that exists for that property. So you have to be able to have options. And one of the major advantages to investing with an operator like Spartan is our scale. We can take our entire portfolio of over $500 million in assets, break up the portfolio into smaller individual properties or individual sales. The other thing that we could do is we could sell the entire portfolio to a REIT. And what this means to you is that if we did a wholesale sale of our entire portfolio, that would be at a lower cap rate, giving a higher sales price per property potentially and a higher return to investors. So that's a really big advantage. And then, of course, we can always sell the properties one by one. We have a lot of 1031 money that is looking for safe, reliable income, and storage is becoming a really hot asset class. So speaking of the portfolio, this is just kind of an overview of what our portfolio looks like. You can see that we're heavily concentrated in Texas, Florida, Georgia, Tennessee. We have a smattering of properties in Colorado, Wisconsin, and then out in the Pacific Northwest. And these are the places that we're going to continue to invest because this is where the migration patterns are going. This is where population is going, strong job growth, etc. And currently, we're the 40th largest operator of self-storage in the United States. So you might think, well, okay, so that's pretty big, but really, we're kind of a medium-sized fish at best. So when we think of ourselves selling our portfolio or having an exit strategy and having that optionality, we kind of think of ourselves as like a portfolio aggregator. We go out and buy a bunch of mom and pops that the big REITs and institutional players really don't want to mess around buying. We aggregate those all up into a portfolio, and then there's 39 larger operators that have a significant amount more of cash to go out and buy these properties, and they like to buy up portfolios where they can get scale themselves. They like that same scale that we get by clustering properties and having many in one market, etc. Likewise, there's a lot of mom and pops and a lot of people that are getting into self-storage. So we've found that we've had many offers on one-off properties as we go through our sales cycle. There's cash that needs a home, and storage is a great place for it. So we found that even if we don't have the strategy of selling to a REIT or something like that, we can sell properties off individually, and that's played out really well. The other thing that we do is we refinance properties or recapitalize properties, but overall, our goal is to get your money back plus a return in 5 years, whether it be through a refinance, a sale, a partial sale, distributions, etc. We want to get that closed out. So have we ever done a fund before? Yes, we did Spartan Storage Fund 1 last year. This is very similar to the Spartan Storage Income Fund this year. Almost identical in that we're going to buy properties in secondary, tertiary markets throughout the United States, high growth states, good population, and deploy our value add strategy. And sometimes we might even buy a core plus asset as well. This is what the Spartan Storage Income Fund bought last year, or Storage Fund 1 bought last year. And we're going to buy something very, very similar to this. So you can see 6 assets were purchased last year. The fund was about $65 million of assets, and we purchased them in markets that had strong population growth and economies of scale with other properties. So you can see we picked up 3 in Louisville, Kentucky, 1 in Chattanooga, where we have 3 other existing facilities, 1 out in Havelock, North Carolina, and 1 in Bonita Springs, Florida. So how does the income fund process work? If you were to place funds on March 1st, what would happen? Well, first, funds are accepted on a first come, first served basis. They're deployed on a first come or first in, first out basis. Once you fund, and your funds go active or used in the income fund to buy property or make improvements, 100% of your capital goes active. And 100% of your capital is called at the time that you decide to make the investment. And then you benefit from all of the properties in the portfolio or in the fund, in the income fund. So you're not going in at a certain basis. You get the original basis of what we purchased the properties for. So if the fund ends up buying 7 properties and you come in after the 7th one is purchased, you would benefit from the previous properties that were purchased all the way back to the first one. And then after about 90 days of your investment being activated and used in the fund for the purposes of buying an investment, you can expect distributions to begin, and they're done on a monthly basis. How do we report? So we do monthly updates. So on the first of every month, you get a newsletter about your investments. You also get a newsletter on all our prior investments. So you're going to see everything that we have going on. We disclose trailing 12 financials. We have a small narrative that you can see here that explains what we did for the month. It's a monthly update. So they're pretty brief, but they're to the point, and they're kind of the so what of what's happening on the investment. We also share pictures of any construction projects. We share pro forma versus actual, and give you kind of an overall financial picture so you can really dive into the occupancy trending data, the pro forma data, the trailing 12 financial data. All that kind of stuff is in our monthly updates. And again, we share the financials. We do monthly distributions, and then we guarantee that K1s for the purposes of your investment are delivered in the March timeframe so that you can get going on your taxes and you don't have to wait for us for K1s. So we're getting to the end, but I just wanted to kind of highlight the 3 different funds for this year, the income, growth, and debt fund. And you can learn more about this by going to spartan-investors.com/2023-funds/. There's also a QR code on the screen there. If you go to that QR code, you can get on our wait list and be notified first of when the funds go fully live and they open up. And that is expected to happen on March 1st, 2023. So if you want to join the wait list, that's a great place to do it. Or if you want to submit your investment on March 1st, that will be available to you on the investor dashboard. So I'd like to transition the webinar into FAQ. So we have some frequently asked questions about the Spartan Storage funds in general, and specifically we're going to talk about questions on the income fund. So the first question I have is, do I have to be an accredited investor to place funds into the income fund? And the answer is yes. This is done under 506C, and accredited investors with an accredited investor certification is required. Next question. Do the investors receive the benefit of bonus depreciation? Yes, we do bonus depreciation, a cost segregation study that provides this opportunity. And again, about 30% of your original investment amount can be expected in depreciation. The next question is, what tax documents do I get? Do I get a K1? Do I get a 1065? The answer is K1s are delivered in the March timeframe. And when do I start receiving distributions? We've gone through this. But 90 days following when your funds go active into the fund and they're actually utilized. Next question is, what is the anticipated cash flow? Again, 4 to 5% in year 1, and then it kind of increases after that as we get our value add strategy fully deployed. And what is the frequency of distributions? They come out on a monthly basis after your funds have been deployed and about 90 days thereafter that. Capital calls. We don't have a provision for capital calls. The capital calls, once you decide to make an investment, 100% of the cash is due, and then it's first come, first served basis after that. Can I invest with my retirement account, SDIRA, 401k, etc.? Absolutely. We have a pretty fair number of investors that use their IRA, 401k, etc. to invest, and you can absolutely do that. How long will we be placing capital? It's first come, first serve basis for placing capital. So next one, is there a redemption period? For the income fund, there is no redemption period. So the investment is an illiquid investment, and the target hold period is about 5 years. I say 4 to 6 years. There is no guarantee that right at 5 years it's going to suddenly come back to you, but the investment is considered illiquid. Can I increase my commitment through the fund? So let's just say a lot of investors, I can't remember the percentage exactly, but a lot of investors in Spartan Storage Fund 1 invested some money, and then later on in the year they invested some more money, and they increased their commitment throughout the course of the investment. And the answer is yes. You can invest more later on, but it's subject to availability. Obviously, if we've filled up the fund already, there may not be available spots left to do that. So with that, I'd like to just offer that any questions that you might have, just email us at investors@spartan-investors.com. Similarly, reach out to one of our team members, Ted, Lauren, Ed, Roy, myself, and we'll get right back to you with your questions. And we wanted to thank you for joining us. Thank you for watching the income webinar, and we appreciate you tuning in, and we hope that you'll join us this year in one of our storage funds. Thank you.